Thank you for tuning in. What you're looking at is the TexasInvestments.com website About Us page, an investment club here in Dallas, Texas, detailing who we are and what we do. I'm the club president, Lee Ennis. In this video, we'll detail what we're currently invested in, why we've invested, and what our outlook is for the market. Hope you enjoy and learn something.
All right, what's going on, guys? Happy October. Really excited today because been away for a while, and by the looks of things, we have lots and lots to sell. Looks like McDonald's. We have to get rid of that for sure. The price is going up way too high, and we don't like getting into anything more than about $120. So we're definitely going to get out of that. We got in at 118. I think it's up to like 157 now, so that was a pretty good run. Bell up in Canada, Xcel Energy's got a pretty good run going. Looks like ExxonMobil has fell quite a bit. I was really hoping to get it really cheap at around the $76 range. I think the furthest it fell was maybe 79. So I think right now we'll be able to get into it at about 82, which isn't too bad. Looks like Pfizer still hanging on, Coca-Cola still hanging on, GE still hanging on, Equity Residential is a holding. It's one of our largest holdings actually, and we finally have some profit back on that, so that's pretty good. Weyerhaeuser still holding on. Sunlight Financial, it's a pretty good run. Texas Instruments is way up. I think the price right now is something like 89. We got in at 76. So we're gonna sell some stuff, and we're gonna look for some replacements. So what we're gonna do first is we're gonna go to our chart here and just take a look around and kind of see what's out there for us. There was here we are. This was last month. What I like to do is I like to look at what has failed the furthest, just to see what is likely to rebound the next month, and it works pretty well. As you can see, from August to September last month, looks like finance and the basics, finance and basics fell the furthest, and looks like in October you see they've rebound the most. So this month in October, looks like we have real estate and utilities have failed the furthest, so we're looking at a rebound from them, particularly the utility sector. It'll be really nice to see real estate come back, but we'll be happy with getting into a cheap utility to replace Xcel Energy if we have to. And of course, you know, if we don't find a replacement, then we'll just kind of shave off what we have. Like Bell, we have 32 shares. We can get rid of some of that. Xcel Energy, we have 14. We can maybe get rid of some of that. Equity Residential, we can definitely get rid of some of that. We have 48 there. Sunlight Financial, can't get rid of anything more than what we have. Really the same thing with Texas Instruments. So let's get into this and see what we got going. All right, so first things first, McDonald's, that is in the consumer sector. Let's go to our table here. Also, it's really important to note exactly what we are scoring right now. Looks like down. So we're fairly defensive right now. Take a look at our hot chart here. Here it is. There we go. All right. So this is kind of a hot chart. It gives you a gauge of what portfolios are doing what over the period of the past year. Red is worse, green is best, of course. So here we have September 2nd to October 2nd. Looks like the up moves, which is an alpha play. Up moves again means that whenever there is more than the average amount of volume, this particular stock seems to move in a positive direction most of the time. Okay, and so we see now that those alpha plays are really what's getting the job done, and that's been the case honestly for the past year. When you look back, we see all this green for return, for alpha, for up moves. Down moves has some returns, some decent returns for the past year, but you see here in the last 6 months or so, they have really been hit hard. And that's just because right now the market is favoring growth, which is a great thing because we always want to look for growth, but we have to remain defensive. That's what has worked for us in the past, and so that's what we're going to stick with until next year when we reevaluate our portfolios. Standard deviation, that's basically the less risky companies, and you see that one has been pretty flat. It's a bunch of yellows in there, a couple greens, not much. See, beta's defensive. Again, got some greens for returns. Doesn't do very well. So my concern is what has worked previously. What has worked recently? Okay, that's what we're looking at. We're talking, past 4, 5, 6 months, and so we're just looking at this bottom couple lines here, and we're looking for those shades of green and yellow, and just kind of scrolling through this thing, kind of going away from the shades of red. Oh, see, that's real bad there. It's important to note what's not working too, and this is all dividend plays, because again, that means the market is looking for growth. They're not looking for a defensive, pay me a dividend, don't go anywhere stock right now. It's all about what can pay me. So really nothing has done really well. This beta is a defensive portfolio, and it seems to have done fairly well over the last 4 months. Looks like standard deviation again is a defensive. Here we have those. Again, these are all betas, so those are all defensive with basically alpha thrown in. You got your beta return, beta alpha, beta up. Excuse me, are all going to be your alpha plays. So it's a defensive portfolio with a little bit of alpha thrown in, and that's why it's done so well, especially in the past 3 months or so. Those are doing okay. Those are all your alpha plays. This one looks really good. Return standard deviation, again, that's alpha mixed in with less volatility, which is what standard deviation represents, volatility. This one, same thing. This is your alpha with less volatility, and it wasn't doing so great compared to its neighbors at the beginning of the year, but we see here over the past 5, 6 months, it's done fairly well for itself. So we'll look at that as well. Let's see, a lot of these again kind of flat, and that's to be expected of these. These are 3 different things kind of mashed together, and honestly, I don't like them, but I keep them around because they do offer some differentiation amongst the other portfolios. So it can tell us something. And you see how well they've done at the beginning of the year. I mean, that's just great. That's a 3.39 average over the course of 6 months at the beginning of the year. That's pretty good. And then same thing here. All right, let's take a look at some raw numbers here to see how everything stacks up. And what we're looking at, this is literally the portfolio grade, okay? And so we see here over in the corner, this is the name of the portfolio. This is the all dividend stocks portfolio. And as you see, it's returned 25% over the past 12 months. And that's horrible. But again, that's indicative. I always have a problem with that word. Indicative of what's been going on in the market lately. So we're looking for a big number here. Let's see what we find. Got 5, 4, 2, 9, 14. So far, 2 is my largest, 1.99. Oh, there we go. 284. And keep in mind, this is an average, a monthly average, okay? And what I've done is the number you see highlighted in yellow, that is the average monthly return subtracted from the standard deviation, which again is a measure of volatility. Looks like so far 593 is my largest. Let's keep going down the list, see what else we have. All right, and as always, I'll come back and look at the worst, but I think we've already seen the worst, which are those dividend plays, which, like I said, you know, it's a telltale sign. All right, so the second largest looks like down moves and standard deviation, which is volatility, and then up moves and volatility. And so again, this is a bit defensive with that alpha thrown in. So that's kind of what we're looking for. Like I said, overall, for the previous 12 months, the down moves portfolio performed the best, and so that's what we've been scoring everything as, and I'm happy to continue following that with some discretion, you know. Let's see here. So down moves 12 months looks like 992, which is horrible. May have to take another look at that to see if we have this thing scored properly. But either way, all right. So we know right now, last 12 months, what has been working is our up moves and standard deviation. So let's take a look at that portfolio. Let's take a look at that portfolio and see what's in it. Uh-oh, one more. There we go. All right. Take a look at this portfolio and see what's in it. So this is up and standard deviation. So we're looking for up and standard deviation. Standard deviation. almost there. Up, down. There we go. Upper standard deviation. All right. So this is what we have. We got GE. We got Toronto Dominion. SCP. Don't know a whole lot about SCP. International Paper. Philip Morris. NLY is a new one for us. Haven't done a lot of homework on that one. Seagate's an old favorite. SWM, not sure about that either. Again, not a lot of homework on them. AEP, SJR, and OMI. So, again, I have some homework to do. A lot of these I know quite a bit about. We're already in GE, so that's good. International Paper, I know quite a bit about that. Philip Morris, know quite a bit about that. Seagate, of course, like I said, is one of my favorites. So it's good to see some companies in here that I like that we can go with. Let's take a look at the ones though that we don't know a lot about to make sure that there's no outliers in here, which means companies that may have ran really hot really fast, and that's the reason why this portfolio has done what it's done. So let's just take a quick look at the purchase price and the current price. This purchase price is as of December 1, 2016, I believe. I'll have to go back and look at that. Matter of fact, let me do that now. Let's see, purchase price. Stock sheet 1. Okay, so no, okay, here we go. June 2nd, 2016. June 2nd, 2016. All right. So, June 2nd, 2016 is our purchase price. See, GE fell. Toronto Dominion had a really good run. SEP fell a bit. International Paper had a really good run. Philip Morris up a little bit. NLY up. Seagate up. SWM up. AEP up. SJR up. Then OMI, big fall. But, you know, we don't have to worry about that anyway because we're not doing anything with our Pfizer position anyway. So what we're going to do some homework on is SJR, AEP. You're going to definitely take a really good look at Seagate again. NLY, I'm really excited about because it's so darn cheap. So that's something I'm definitely going to take a really good look at. What else? International Paper. Again, I want to make sure we're not getting in at the super highs. But it is a good company though, and we like that. Toronto Dominion. I know about the company, but I don't know what has happened recently with the company. So I definitely want to do some homework there. And then I think we're going to go ahead and get some more Exxon Mobil. So let me do my homework and get back to you.